Hello and good morning, everybody. I hope the weekend treated you well. It was Super Bowl weekend, which is actually a holiday in my house because we love football around here. So, for all you football fans, I hope you had a really good time. Sorry to my Eagles fans. I hurt you. Maybe next time. Chiefs fans, way to go. I'm sure you guys had a lot of good time celebrating. I'm a Cowboys fan, so we weren't there. But it was a really great time this weekend. Got to see Kevin Hart, got to hang out with some really cool people downtown, and just enjoy the ambiance of the Super Bowl being right here in Phoenix. So I hope you enjoyed your weekend too. Today, I'm going to take some time to talk about some market trends, what they mean, how they affect real estate, and what that means for us as consumers in these markets. All right, so let's hop into this. We're going to talk about short, intermediate, and long-term markets. The most commonly talked about are those in the primary market, right? There's a bull market and a bear market. Those last about 1 to 3 years. Now, the way I remember these is that in a bull market, as a bull stands up on its hind legs, it is rising. That is the same for the stock market. In a bull market, prices are increasing and they're doing it fast. Though that lasts probably like around 9 months or so. And then there's the bear market. U of A bear down. That lasts about a year as well. Same thing. So a bear market is when things are on the decline. Prices are dropping. Typically, they are determined at the 20% mark. Once prices have fallen 20%, it looks like we're in a bear market. These markets last 1 to 3 years in time, but there's a bunch of intermediate markets in between that we'll talk about a little bit. So next there are these secular trends, right? Secular trends can last 1 to 3 decades, kind of like what you see what's happening now, right? 2001 happened, we went up, we went down. 2006, 2008 happened, up, down. Here we are in 2023. And so secular trends are things that we just want to follow over time to kind of gauge what history looks like to predict what the future is going to be. All right. So then there's these intermediate trends that occur. They last about 2 to 8 weeks in time. They're found whether we're in a bull market or a bear market. And they have to deal with rallies and turnarounds. So usually they are the result of an economic or political action. I don't know if you've noticed, but every time it is time for the primaries during election time, there's always some crazy thing that happens in the market, right? In bear markets, right, the rallies create really strong reactions and then they're short-lived. We see nothing after that. Then there's those bull markets, right? Strong rallies, but the reactions are kind of weak. The combination of what's happening in the primary and secular trends and the intermediate trends, it kind of creates those long-term trends that I was talking about, where we see those secular ebbs and flows, right? They last about 25 years or so. Now, these are dependent on several variables. Most commonly talked about is the rate of change, which the rate of change is the most recent closing price divided by a closing price a number of days in the past, and now you've got the rate of change. So let's talk about what that means for real estate, because let's be honest, what's happening in the stock market doesn't necessarily indicate what's happening in the real estate market, right? In June of 2022, the S&P called it a bear market, right? Things were dropping and nobody knew what was going on. Well, here's the thing. Home values in Arizona specifically increased by 10.6% last year. Over the past 5 years, that's 25% of the growth happened last year. So that definitely was not indicative of a bear market in the real estate industry. It did take a turn, however, when we reached the highest interest rates in real estate that had happened in decades. It peaked at 7.18%. That was a huge turn because what that meant is that buyers were unable to qualify for houses. Now that created a buyer-seller mismatch because for all the houses that were on the market, there weren't enough buyers to be able to purchase those. Okay, so now let's fast forward to 2023 and let's talk about what that means for you. First of all, interest rates have started to come down and they have looked pretty steady over the past 30 days, right? We're in the 6.18, 6.12%. What this means for consumers is that now sellers can feel more comfortable selling again because buyers are now able to qualify again. With more buyers on the market, I expect to see more inventory out there because sellers are more comfortable that they're going to be able to get a good return on their investment. For 2023, the projection is that, there's going to be less than a 1% value drop in homes. So with that, buyers can now qualify for homes again with those interest rates dropping. Also with that, sellers can feel comfortable that they're going to get a good return on their investment and they're not selling themselves short. So in this situation in 2023, it looks like a win-win for both buyers and sellers. So my message to my buyers is to get pre-qualified now so that you're in the game. To my sellers, call me for a CMA. I'd be glad to help. That concludes today's video. Thank you so much for hanging out. Do be blessed, be safe, be prosperous, and you can reach me at any of my contact information below. Take care.